Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, what about the people who are right 9 times out of 10 and they still lose money? That's the world of not only a Condor trader, but also a credit spreader. If you trade iron condors, does that mean that you're going to be right 9 times out of 10? No, I don't mean that at all. It's a possibility, but I don't mean that necessarily. These two examples are extreme examples. If you're right a majority of the time, you don't make a lot of money on the iron condors every time that you're right. But the income is nice, and when you are right, you feel like the smartest person in the world. You made 4% last month. There's bonds out there that are struggling to get 3 and 4% in a year, and you just made 4% in a month. You feel like the smartest person that ever walked the face of the earth. And your risk was so low that the market had to move 8, 9, maybe 12% for you to even start to lose money. Now, what are the odds of that? Well, the odds aren't very high most of the time. You do it again the next month, and you're feeling smarter and smarter every month that you're making money. However, month 10 comes around, and then all of a sudden you get to that point to where the index, the currency, the stock, whatever you're trading with gets close to the short strike price, and you're getting nervous because you didn't have a plan before you got into the trade. You're wondering, why did I get into this Condor trade in the first place? I didn't want this to happen. I set my strikes so far away from the price of the underlying that I wouldn't have to be in this mess in the first place. Now, all of a sudden, if I get out of this trade right now, I'm down 58% on my trade for this month. And all those 3% months that I had the last 7 months, I spent all that money. I used that money as income. My annuity payment is gone. I'm done. I'm now a losing trader right now. You have that horrible feeling in you, and with that, a lot of times it's because people don't have a plan before they get into the trade. Once again, money management is the key no matter what you're doing. If you're a buy and hold investor, I have no problem with that. Buy and hold, if you're buying and holding the right thing, then it's a good thing. Now, let's move on. What is your plan? The thing that I've told people for many years, what if the stock goes up, down, or sideways? What if the currency goes up, down, or sideways? What if the commodity goes up, down, or sideways? Make your plan before you get into a trade. Right now, as an example, I have absolutely no opinion on XYZ stock. Now, XYZ stock can be whatever stock you want it to be. It doesn't matter for the purpose of this illustration. What I would do if I'm looking at XYZ stock, I would say to myself, okay, XYZ is trading at $60 a share. If it goes down to 40, that's the point that I'm wrong. That's the point that I'm going to get out of the stock. If XYZ goes up to 80, that's the point that I'm going to take my profits. I put in a one cancels other order. It's very simple. I put it in before I get into the trade. However, let's say that I get into XYZ stock, and that's my plan. I have the mental stop loss, so to speak. Well, if that's the case, it gets to 40. And right as I'm moving my hand over, I put my finger on my mouse pad, it goes back up to 40.08, jumps up 8 cents. Well, okay, I'm going to stick around for this. I'll wait a second before I put in the sell order. Goes up to 42, goes up to 44. Oh, I'm glad I didn't do that. Then the stock goes down to 40 again. You're getting ready to put in your sell order again, but then it right away jumps back up to $40.04, and the same thing happens again. And maybe it happens another 2 or 3 times, and 40 is definitely a bouncing point for you. But now, the next time it goes down to 38.94, bounces back, goes down to 38.22, bounces back. You still stay in it though. And you're feeling more and more confident every time it keeps bouncing off this low. You're still not happy because you're still in a losing trade, but you're not getting killed on it, so you stay in it. Then all of a sudden one day, their drug doesn't get approved, they have bad accounting, or they have some type of a bad earnings report, something bad happens, and the stock's now at $24 a share. You're not feeling too happy right now. And with that, there's a lot of people in this audience that have probably been there, done that at some point in time. And with that, the point is, put in your orders before you get into the trade. Now, let's say that you think the stock needs to, I'm looking at XYZ stock, and I think, well, XYZ could go down to 22, but I think it could go up to 88, but I need to allow for that much risk for this trade to work. That's fine. I have no problem with that. The way with which you set your risk parameters on that is by putting on a small position. If you have a small position and you limit your risk, or you just use a call, or you buy a protective put, something along those lines, then you have risk management put in place. Staying at this is the key. Now, what is the iron condor? Traditionally, the iron condor is two credit spreads used to create a neutral trade. There's designed to be limited risk with the iron condor trade. What you're hoping is that the stock, the index, or the currency stays within a range. On this risk graph over on the right-hand side, this is an iron condor on the euro. What we have in here, you can just see the short strike prices are 69 and 73. This is not a recommendation, by the way. This is just a random example that I used to kind of show how this trade could work. Your maximum risk on this trade is $78. Your maximum reward is $22. And this is just on a one lot. So with this is approximately a 25% profit. All the euro has to do, or all EUI has to do, is stay within the 69.73 range. So with that, this is something that you're looking at when you believe the marketplace is going to stay in more of a range, if you will.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.